Thank you, Nargis. Thank you very much indeed for inviting me here. I'd like to thank my students for what I'm about to talk about, because it's these questions, their queries, their comments that have led to the ideas, shaped the ideas that I'll be presenting. Let me also thank Nargis for offering my name to the Friedrich Ebert Stiftung without my knowledge at the time, but she has the permission to utilize resources at KIMEP.
I'm proud of it.
A bit. Today I'm going to talk about the drop in the price of oil that has occurred, the price of crude oil that has occurred in the year 2014, and the consequences thereof for the Kazakh economy. It is helpful to know what else went on. After all, whenever any event occurs, we need to ask ourselves the question, what else happened among related matters? How did it come about? So if we know the cause and we know how it came to pass, then we have a better chance of being able to tell how it will unfold. So that is the object. It's a good idea to examine what else happened. This chart gives the indication of how prices of almost all the major traded commodities in the world have changed during the last 1 year. Gold has dropped 4.25%, silver 19%, copper 12%, platinum 12%, and so on down the line. West Texas crude, these figures are from a few days ago. It says 21.57%. It is actually a number slightly bigger than that. And if you go down the line, you'll see that even the euro has depreciated against the dollar by 9%, the Japanese yen by 11%, and also the Swiss franc. So almost all commodities denominated in US dollars have fallen in price year to date. As have all the major currencies fallen against the US dollar. Naturally, the dollar has appreciated. Once we get an inkling that the dollar has depreciated, then we ask ourselves, what brought that about? Well, we have a new Federal Reserve chairperson, Janet Yellen, and she decided that she would put a halt to the expansion of money supply that was being conducted at the rate of $60 billion every month. This was over and above the normal rate of growth of money supply at the rate of GDP growth, which is done in order to avert deflation. But this was an extra $60 billion being injected every month in order to buy what was called troubled assets, toxic assets, under the TAR program, Troubled Asset Repurchase Program. So Janet Yellen decided that this had gone on long enough. $4.4 trillion of bad debt had been bought by the Federal Reserve System, and enough was enough. Clearly, if you stop increasing the supply of a commodity, in this case US dollars, its value, market price will appreciate. So we know that that has happened. What is remarkable in this table is that if you look at natural gas, the price of that has barely changed. It's negative, less than 1%. And of course coffee, but coffee is coffee. Starbucks can monopolize it. Okay. So we need to keep these facts in mind as we proceed to examine what has happened to the oil market and how it will impact the economy of Kazakhstan. A global perspective is helpful. Who are the major players in the world? This is a list of the top 15 countries by GDP in 2013. And if we examine this, $55 trillion out of 74 trillion is accounted for by simply these 15. On the left-hand side, we have the major oil importing countries, the top oil importing countries. And we can see that the blue line is for the United States. Its imports of oil, annual imports of oil, had reached almost $11 trillion, and they are now just a little bit above, about 8.5. So there has been a decline in the import of oil. On the other hand, China, with the red line, has been steadily increasing its imports. India's green has also been going up. Japan has stagnated for a while, and therefore its line, the black line, has flattened out. South Korea is again importing a fair amount. Now, what about exporters? On the left-hand side, we have imports. In the middle, we have the major economies of the world by GDP. But what about exporters? Well, in Iraq, 50% of the GDP comes from crude oil exports. Saudi Arabia, 38%. Nigeria, 28%. Kazakhstan, 25%. It was $55 billion per year, 2011, 2012, 2013. And given a 225 billion GDP in 2013, it comes out to exactly 25%. Russia is only 10%. Clearly, an economy that is a bigger exporter of crude oil will be more adversely affected when the price of oil drops. So whatever is happening in Kazakhstan is not the worst that is happening to any country in the world. Much worse is happening to Iraq and Saudi Arabia. And Russia is far less adversely affected. Now, there's a theorem in international trade that says that if a country's terms of trade improve, that is, the price of its exports divided by the price of its imports increases, then that country experiences an increase in its real GDP. Naturally, its trading partner, whose terms of trade have worsened, will experience a loss of GDP. So since the prices of traded goods have changed, the price of crude oil has, for example, fallen, every oil exporting country will experience a drop in real GDP, and every oil importing country will experience an increase in GDP. And these increases or decreases will be proportional to their initial volumes of exports and imports respectively. The larger your volume of and the percentage of your exports coming from GDP, the bigger will be the hit you will take, and the larger the volume and therefore the value of proportion of imports in GDP, the greater will be the benefit in terms of real GDP. Now, in 2015, the change in 2015 GDP, this is probably the calculation part of this, presentation, and will require a little bit of effort on our part. The rest is all easy peasy. So the change in 2015 GDP will be 25%, which is the proportion of GDP of RK that comes from crude oil exports, times minus 24.51%, which has been the drop in the price of West Texas crude, which is closest in quality to the type of petroleum that is produced and exported by Kazakhstan. I'm assuming that the price of petroleum has fallen from $102 a barrel to the price today, which is $77 a barrel. Yesterday it tested the price of about 76, 80 or so, but today it is 77. So 25% of 24% comes out to be negative 6.3% of 2014 GDP. We now need to figure out what that will be. Now in 2013 the GDP was 225 billion. And the increase in the GDP this year will be just shy of 3%, or 6.43 billion. How did we arrive at this calculation? Well, for the first 9.5 months of 2014, RK was supposed to grow at the rate of 5%. But in the last 2.5 months, it took a hit of a negative oil price shock. So combine the two effects, the positive, which was the natural rate at which it was growing, with the negative shock, we come up with a simple number of 6.43 billion. So 225 billion, add to that 7 billion, it becomes 232 billion. That will be the GDP of 2014, to which we will apply now a 6.1% reduction, and then we will arrive at what will be the GDP of Kazakhstan in 2018. That's the calculation. So the story is 2012, GDP was 202 billion. By 2013, it went up to 225 billion. By 2014, it will be 232 billion. But unfortunately, in 2015, because of the adverse price shock, it will be 218 billion. That is unambiguously a recession. When the GDP of a country falls, we call that a recession. But that is without any government intervention, left to itself. As it happens, there are forces in place that may this time lead to the lower price being sustained for a longer period of time than was previously the case. As some of us will recall, in June of 2008, the price of West Texas crude had risen to $140 a barrel. By January 2009, it had dropped to $42 a barrel. But then this was also the aftermath of the financial crisis, when the United States injected $700 billion and another $700 billion as part of the stimulus package. 600 billion or so was injected by Germany, 500 plus was injected, $1 billion injected by France, Britain, and so on. There was a massive amount of government injection of spending to revive the world economy. Now the US dollar has appreciated, all commodity prices have to fall. There is also higher production of shale rock gas in the United States, that is natural gas from fracking of shale rock. And while the appreciation of the dollar will affect the prices of all commodities and cause them to fall, the increased production of shale rock gas, which is a substitute for petroleum, will likely effect a greater decline in the price of crude oil and will keep it down longer, as long as those supplies are available. We also have, so one is an increase in supply of a substitute, shale rock gas, which is coming online in greater and greater volume. But the Chinese rate of growth of GDP has also slowed down. It was around 10% or so for a whole decade, 2 decades or so. It has slowed down to 6.7%. So there will be less demand, increase in demand coming from China. India's rate of growth has also slowed down from about 8% to about 5.5%, less demand. Baby boomers, which is a huge chunk of the population, a big bulge in North America, Western Europe, Japan. These are people born after World War II, between 1946 and 65. Somebody who was born in 1946 turned 67 years of age in 2013 and starts retiring, and these people go on retiring for the next 20 years. Retirees spend less money than working and business folk. There will therefore be an additional source of contraction of demand for all commodities, including therefore crude oil and petroleum products. In addition, for the first time in recorded history, Japan has a public debt to GDP ratio of 240%. United States, 110%. Deutschland, 65%. UK in the neighborhood of 80%. So when, and this was not the case when the financial crisis hit, but it is the extra spending that has led it to rise to such high levels. So the major economies of the world no longer have the capacity to come up with another round of additional spending in order to prop up the economy. No rescue package is going to be around. In fact, in the United States, we have a balanced budget amendment, because of which our government shuts down every once in a while, because there are across-the-board cuts. And Germany has been pushing an austerity package upon its own citizens and around, and is unlikely to come up with a large spending package, nor will France or the UK. So who is going to come and rescue the economy this time? And if this rescue is not going to be available, is it not realistic to assume that the lower price will survive for a longer period of time? That would be the natural implication. There is some source of optimism, however, if an expansionary fiscal policy is adopted in RK. After all, the budget deficit in the Republic of Kazakhstan is less than 3%. And the public debt less than 16%. Unlike the 240 and the 110 that we are talking about for the Japan and the United States. So there is plenty of room here. The belt is not very tight. The deficit can be raised and the debt can be increased. But there is a financing constraint. So while RK does not suffer from any of the ills, budgetary ills, of Japan, USA, UK, France, Italy, etc., and therefore increase in government spending is completely feasible, there are some limits, because the central bank reserves are about 28 billion. And foreign exchange reserves are 63 billion. Now, we had calculated that 14.2 billion, last but one line, would be the annual hit that the RK economy would take as a consequence of the negative 6.13% oil price shock. So 14.2 billion is needed every year. How much do we have? 28 billion reserves with the central bank and 63 billion in total. So it all depends on for how many years this expansionary fiscal policy has to be adopted. This should actually be 14.2, not 12.5. So if it's for 1 year, certainly it can be handled. Couple of years, perhaps so. More than that, it's going to be tough times ahead. Now, as it turns out, natural gas is very cheap. In the United States at $4 an MMBTU. In Japan, the price is 4 times as much. In Germany, the price is 3 times as much. And 6 MMBTU of natural gas gives you the same amount of energy as 1 barrel of oil. So, in equilibrium, 6 times the price of natural gas would have to equal the price of crude oil. So, for example, if the price of natural gas were to rise to $10 an MMBTU, and 6 of those units give us the same amount of energy as a barrel of oil, then the price of oil would have to stabilize at $60 a barrel. But as it happens, $70 for 3 years is worse than $60 for 1 year, because there are not enough reserves to meet it. No devaluation will occur, because fall in domestic income implies a fall in import demand. And this by itself implies lower derived demand for foreign exchange for buying these imports. So it is unnecessary for the government to reduce demand for foreign currency by devaluing the tenge, because recession is already causing it. So there need not be a recession, there need not be a devaluation, because the recession is causing a reduction in demand for foreign exchange anyway. So there are tough times ahead, but given the right political will and correct choices made with government policy, some of the effects at least can be partially mitigated. Thank you.